Buenas tardes. I'm going to give my presentation in English. First, I want to thank the ACP for the opportunity to speak at this excellent conference. All of the panels this morning were extremely interesting, and I'm excited to be here from Washington. I'm going to talk about hydrocarbons and economic development. I think that this is a very difficult and complex issue, and many of the related issues are complicated. In my presentation, I want to try to just raise what I think are some of the most important questions, and although I don't think there's a sort of one-size-fits-all solution, I do think we can talk about some practices that have worked in different countries that might be of interest for Colombia. So first I'm going to talk, in the first half I'll just focus on the macroeconomic impacts, and in the second half on the microeconomic impacts. So first I want to talk about oil production and oil dependency. This chart shows the top 15 liquids producers in the world and Colombia. And some of the top oil producers are also the most oil dependent. As you can see here, we've used a measurement of percentage of oil exports as a total of GDP and as a total of exports to decide which of the countries are the most dependent. The ones toward the bottom are the most dependent, and the ones toward the top are less dependent. So Saudi Arabia, for example, the #2 liquids producer after the US, relies on oil for 38% of GDP and 81% of exports. Other top producers, on the other hand, like the US, China, and Canada, are significantly less dependent on oil, relying on it for about 1%, less than 1%, and 0% of GDP, respectively. And of course, in Latin America, Venezuela is by far the most oil dependent, with oil revenues making up 31% of GDP. And Colombia is fairly dependent, but really doesn't come close to these other countries. So looking at some of the impacts of oil dependency, I think oil dependency and oil price, one of the difficulties of oil dependency is you're extremely vulnerable to oil price volatility. So this chart shows the price of Brent crude over time, and the countries near the top are the most oil dependent. So Saudi Arabia, Kuwait, Qatar, we can see that their terms of trade are very much in line with the huge jumps that we see in oil prices. Then the countries with the flatter line or more sort of stable terms of trade are the ones that are more economically diversified, like the US, China, and Mexico. And Colombia is the line that's sort of in the middle, so it's seen some fluctuations, but not nearly to the extent of the really oil-dependent countries. So government revenues, of course, as the panelists have been discussing all morning, are also very vulnerable to volatile oil prices. So when oil prices rose before 2009, most countries' revenues were pretty stable. But when revenues dropped after 2009, when the oil price plummeted, their revenues also dropped. So we can see that Venezuela, Nigeria, the United Arab Emirates, and Saudi Arabia's government revenues all dropped much more sharply in 2008 than the other less oil-dependent producers like Brazil. Now, of course, other factors could also influence this. This was during the time of the financial crisis, but I think that we do see a correlation here. And this chart only goes until mid-2014, so we still have another year, and if you look into 2015, you're going to see a continuing sharp decline in government revenues for oil-dependent countries like Venezuela. Another very important topic when we discuss macroeconomic impacts of oil dependency is Dutch disease, which refers to the increase in the value of a country's currency related to a high concentration in exports of commodities such as oil. For example, an oil discovery will result in a large influx in foreign currency, strengthening the domestic currency and weakening exports from other sectors in the international market. And I'm sure you're all familiar with this concept, but I thought it would be interesting to actually show some of the most recent trade data. And you really see, we actually looked at all of the 15 countries that I originally showed, and you really do see a correlation where the ones on the top which are less oil dependent, clearly have a much stronger manufacturing sector. And the ones on the bottom that are more oil dependent, they haven't seen much growth in the manufacturing sector, and they've seen a huge growth in primary exports. So these are, I think, some of the issues I raised are some of the challenges with dealing with oil price volatility. And there are lots of best practices and ways to try to address this. I think that actually implementing them can sometimes be politically more difficult, but there are some success stories. And so I think that some of the most important measures that can be taken are, for example, sovereign wealth fund, fiscal rules, which Minister Cárdenas mentioned exist in Colombia, and hedging. So a sovereign wealth fund is a state-owned pool of money that's invested in various financial assets, and the money typically comes from a nation's budgetary surplus. And when a nation has excess money, it can use the sovereign wealth fund to funnel the money into investments rather than keeping it in the central bank or channeling it back into the economy. There are commodity-based sovereign wealth funds, for example, in Norway, United Arab Emirates, where a large portion of revenues from oil exports, and the fund protects the surplus revenues from oil-based risks. They're also non-commodity sovereign wealth funds. And the majority of sovereign wealth funds are either savings funds for future generations or fiscal stabilization funds. And a stabilization fund is just a mechanism set up by a government to insulate the domestic economy from large influxes of revenue, such as oil revenue. And this chart shows Norway. Many countries have these sovereign wealth funds: Russia, Chile, Oman, Kuwait, Papua New Guinea, Venezuela had one. Norway's is the largest. In 1969, Norway discovered a huge amount of oil and gas, and it resulted in a lot of instability in the ensuing decades where they were, huge swings in prices that they were dealing with. And then in the 90s, they created a sovereign wealth fund to protect against oil price volatility. And what this chart shows is that even when oil prices are low and when government revenue from petroleum activities is relatively low, their government pension fund still continues to grow exponentially. So by investing government revenues, the fund saves for future generations, and it prepares for depletion of oil revenue because the North Sea is seeing depletion of reserves, so they're preparing for future generations. Another example of a measure to protect against oil price volatility is a fiscal rule, which imposes a long-lasting constraint on fiscal policy through numerical limits on budgetary aggregates. And fiscal rules typically aim to correct distorted incentives and contain pressures to overspend, particularly in good times. So I think, of course, for a fiscal rule to work, you have to institute it before the boom times, and then use the savings in downturns. And Chile has one of the most well-known fiscal responsibility rules, as well as a stabilization fund. Chile's fiscal responsibility law states that the central government's overall structural balance should every year equal a surplus of 1% of actual GDP, and then this was later revised down. So the rule formalizes a commitment to provide for future social commitments by establishing rules for the investment of surpluses. And it establishes a pension reserve fund and an economic and social stabilization fund. So by 2008, the pension reserve fund and the stabilization fund had accumulated an amount equal to 18% of GDP. So during the global financial crisis, savings from previous years were used to withstand declines in copper prices and finance the fiscal stimulus. And so this sort of shows how they were able to smooth out spending despite the fluctuations in copper prices. And then finally, I just want to talk a little bit about hedging, which is a market-based instrument to manage commodity price volatility. countries can enter into over-the-counter forward contracts to lock in prices or hedge price risk with options. And Mexico, I think, is the most famous case of a country that has done this. They bought put options on oil to insure against a fall in prices. Through hedging, their finance ministry pays a premium at the time of purchase, which gives it the option, meaning the right but not the obligation, to sell oil exports at an agreed-upon strike price if the average price of the Mexican export basket is below the strike price. So every year, the central bank and the federal government analyze different market factors to establish the amount of oil that they want to hedge. So it's been, in many years, it's been over 90% of exports. And what's the strike price going to be? And then they use that price in their budget assumptions, because Mexico is particularly dependent on oil revenues. Even though they're a very diversified economy, they still depend on oil revenues for about a third of the federal government budget, or the central government budget. So what's interesting is, you might have heard about the hedging in Mexico, but I think it's interesting to see here over the last couple of years how basically in 2009, in 2008, and in 2014, when prices tanked, Mexico was protected because 90% of their exports were hedged. So there were 2 years where it really saved them. Now, it doesn't always help them. There were some years, it costs a lot of money to buy a hedge. And so there were a couple of years here where you see where the oil price is above the price they got. That means they just completely wasted their money. But it's a type of insurance that I think has worked well for them. And then, of course, this year it's not going to be as good because now the market knows that prices are lower than they were in the past, and so they're not going to get as good a price. But I think it's an interesting instrument that's worked well for them. So I think these are sort of the main approaches for macroeconomic, and as I said before, they can be very politically difficult to actually follow through with, but I think they can be effective. So now I'll talk a little bit about the local and sort of microeconomic issues, which I think are where we see a lot more variation from one country to another. So in most countries in the world, oil-producing regions receive a larger share of oil revenue than non-producing regions. And this is meant to compensate for the local impacts of the oil industry. So this obviously improves incomes. It leads to larger income for the producing regions, but it can also lead to more inequality. So at a national level, we don't see a lot of correlation between inequality or the Gini coefficient and high dependency on oil production. But if you look within a country, it can lead to a lot of inequality between producing and non-producing regions, and even in some countries you see higher inequality within producing regions. So you see a higher Gini coefficient within producing regions. Of course, generally local authorities are receiving a larger proportion of natural resources coming from non-producing regions, even when redistribution mechanisms are in place. So just to give some examples, what I'm showing here is Bolivia. So there's a clear correlation between oil and gas production and in hydrocarbon producing regions and GDP and poverty levels. So the producing regions are Santa Cruz, La Paz, Cochabamba, and Tarija. That's where we see the most wells drilled. And that's also where we see the largest contribution to GDP and the lowest poverty levels. So there is this sort of, within the country, it creates inequality. In Peru, there's a similar situation, but there are some studies that even show that within producing regions, there's a higher level of inequality. That could be, I'm not sure what exactly the reason, but it could be, for example, because the mining well sort of benefits some people within the regions more than others. The people who are able to get jobs, it brings in immigrants in terms of bringing in new talent, and so that could lead to higher inequality within those regions. So I would like to talk about the issue of local conflicts, which has been, and sort of issues with communities that's come up a couple of times in some of the earlier presentations. And I think this ties to the microeconomic issue because inequality appears to be one of the reasons behind the large number of conflicts, although certainly not the only region. A lot of evidence suggests that conflicts all over the world are increasing. I haven't seen really comprehensive data. I think it's hard to know, where all the conflicts are happening in the world. So what I'm showing here is just a case study that took that is by the US National Academy of Sciences, and it looked at 50 cases of company and community conflicts around mining and shale operations. And you can see that they span all geographic regions, and actually Latin America is a large region for conflicts. And they also span all different types of commodities, and even we see even in renewable energy projects, there's been a lot of opposition by local communities. And most of the cases that they looked at are in recent years, since at least 2000. So I think that community engagement is extremely important for oil projects, and local conflicts can lead to huge losses. So again, this is how it ties into the economic issues. For example, there was research by Harvard Kennedy School and the University of Queensland showing that for large mining projects, they use $3 to $5 billion, companies could incur losses of $20 million per week. And another study of 190 oil and gas projects by IOCs showed that the time taken for projects to come online has doubled in the last decade up to 2008. And this could be for various reasons, but risks with local communities is a big part of that. So I think that what people are seeing and discussing in Colombia is happening all over the world. The sources of local conflicts vary tremendously, and you have to really look at each country differently, but generally a lot of it is tied to economic demands, but also land rights and environmental concerns. So a lot of times the issue is that there are a lot of demands for more jobs, more service contracts, more social investments in the community, better infrastructure, and when communities feel that they're not getting that, then they tend to protest. Also, land rights are a big source of conflicts. Mining and oil concessions may encroach on land belonging to ethnic minorities, or in the case of the US, you have a lot of opposition to the shale, and it doesn't necessarily have anything to do with indigenous groups, but it's just people who don't want to see drilling in their communities. Many countries require prior consultation with communities, but I think that the rules and regulations seem to be unclear. So we looked at case studies of conflicts. We looked at Colombia, but also Peru, Chile, and Mexico, and saw that in every country there seems to be some lack of clarity about the regulations for consulting with communities, and there seems to be even a disagreement over the very definition of consultation. Does this mean you just have to inform a community about what's going to happen in the project, or does this mean they actually have a veto power? So, and then finally, the other issue is environmental concerns. There are a lot of conflicts, especially in Peru, for example, are really arising from concerns over environmental issues. And I think that with more and more sort of global communication, there's more awareness about environmental issues, and I think there's also a lot of misinformation, and that sort of spreads more quickly when you have access to information around the world. I also think that corruption and weak local government capacity in a lot of countries can prevent the local communities from reaping the benefits of oil investment. So among the top oil producers, there does seem to be, or among the top oil dependent countries, there seems to be a correlation with corruption. So the countries with higher oil exports as a percentage of total exports have a higher corruption score. What I'm looking at here is Transparency International, so they actually measure perceptions of corruption, not actual corruption. And so I think that, whether there's a real correlation there, I'm not sure, but the theory of why this correlation may exist is that economies that have abundant natural resources have very easy rents that can easily be captured by politically powerful groups. And it's believed that countries that are well-governed and have strong institutions and then discover oil do very well. But if a country already has weak institutions and it discovers oil, then it tends to do very badly. And that's sort of the theory behind why you have corruption in oil-dependent countries. And then the other issue is that just weak local government capacity doesn't necessarily mean that there's corruption, but maybe they just don't have the ability to invest in the right projects, or sometimes they don't even spend the money at all. So I think these, to me, are sort of the top local concerns. And then some kind of issues that, in some ways that you could address these concerns are what I want to talk about next. So I think in the case of the micro level issues, it's really varies a lot from one country to another, so there's no one size fits all solution. But these are some of the approaches that I think are the most important. So broadly speaking, I think I sort of broadly categorize this as more government intervention. When we looked at a lot of different countries in Latin America, we saw in all the cases that proactive and sustained government-led engagement from the start of the project was one of the most important factors. Also, the ability to increase institutional capacity. So for example, I think Mexico is very interesting because of their oil reform, they're just starting to look at what's it going to be like for us when we have private companies operating in the country. It's been a monopoly of the state for so many years. And so they're aware of the problems that happen in other countries, and they have conflicts in the mining sector, but they have very low conflicts in the oil sector. And that's because Pemex has been able to provide very strong corporate social responsibility programs, and it's really the government. So I think in every country in Latin America, state oil companies, because they're the government, they're going to have a very different situation and usually an easier time in their engagement with communities. And so Mexico, for example, they've created a department that's exclusively dedicated to dealing with conflicts and administrating a consultation process, but we don't know yet, who they're going to put in that department. Will it be a lot of people who are experienced and have the ability to go all over the country and engage in dialogue, or will it be sort of one person who doesn't really have the resources to do very much or not that much experience? So I think that's really important. Also, just communication, within the government and then with the communities, obviously that's very important. Clarifying the role that companies have versus the role that the state has. I think a lot of times local communities have expected economic benefits that don't materialize, and the government needs to intervene to set expectations about, what the role of the state is and what the role of the companies is. And I think that also in Latin America, state oil companies in all cases have had an easier time. And I think, as I mentioned, that's also the case in Brazil and Ecuador. So I think, dealing with what the role of a private company is really important. Another issue that I think can help address kind of the microeconomic issues and help to improve the impact that the industry has on local economies is developing human capital and service suppliers. So again, I want to talk about Mexico because, again, I think that they're an interesting case for a lot of issues because they're trying to figure out what they're going to do. And they've looked a lot at the issue of human capital, and their expectation was they're going to see a huge increase in demand for jobs. Those jobs need to be filled with local talent, and how are they going to make sure that they're prepared? They're expecting to have about 135,000 new jobs, new direct jobs, and another 135,000 new indirect jobs. 80% of those are going to require technical training. So most of the jobs are not requiring, a bachelor's or doctoral degree, but vocational or technical training. So they've done a lot of work to identify the skills gap and what their needs are going to be. And then they've also developed programs where they can retrain engineers and other technical workers who may have experience in other sectors, but they don't have experience in the oil industry. And they also have to have a separate training for regulators because the issues that regulators deal with are completely different from what private companies are going to deal with. So this is just showing, they also created some new funds out of oil revenues where they'll offer scholarships to study oil-related fields and energy-related fields. Another issue is local content. I think local content requirements can be challenging, but there is an opportunity for companies to create jobs by developing the local supply chain. So I think you can see cases where local content has worked really well and others where it hasn't. And I think I use the Norway example as a positive example because in the 70s, Norway, their emphasis was really on promoting technology transfer and R&D. And they basically, if a local company was competitive in terms of price, in terms of quality, then they would have priority over foreign companies. And they also encouraged companies to enter into R&D contracts with local companies. So they really encouraged technology transfer, but they didn't impose very onerous local content rules that couldn't be met by local industry. And in my opinion, that's sort of what Brazil did. I think they created a reform, they set very high standards for local content, but they didn't really see that the industry was actually prepared to meet them. And so that's one of the reasons why production in some fields was so delayed, because Petrobras would have a really hard time procuring equipment. You know, FPSOs are not very easy to build at a competitive price if you don't have a lot of experience. And I think the Brazilian industry wasn't ready for that, and now they're really starting to reverse that policy because it hasn't worked. So I just want to briefly mention environmental regulation, even though it's not an economic issue. I think because of what I mentioned about sort of the delays and losses in investment, it really ties into the economic issues. And what I want to say here is that obviously upholding environmental standards is extremely important. I think that in the US, you know, speaking from what we've seen in the US on the shale industry as well as offshore after the BP Deep Horizon oil spill, there are some practices that have been developed in the US that have worked better. For example, it's really important to establish data from the beginning. So on water quality, the EPA came out a few months ago with a study that took them 5 years where they found that basically the impact on water had been not significant, they said, from shale, but it took them 5 years to do that. And if you can collect a lot of data before you start drilling, that's a lot better because then you're going to have a better sense of what the impact has been. They're also separating the environmental regulator from the licensing agency, obviously regulation of well construction, transparency on what's in the fracking fluids, and addressing air pollution. These are just some of the practices, and I think it's really important in terms of sort of getting the confidence of the local communities and protecting investments. And then finally, obviously investing in sustainable projects is really important, and this is kind of a very broad way of putting it, but I think there are a few specific things that you could say, you know, investing in education, infrastructure, like what Colombia is doing. And then I just want to point out that it's usually not a good idea to invest in energy subsidies because that's very wasteful, but a lot of countries, and this map just shows, you know, it's not just Venezuela. A lot of countries, major oil producing countries all over the world have big oil subsidies for consumers. And also transparency is a way to provide more information about distribution of rents and avoid some of these challenges. So I will conclude with that. So thank you very much.